What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right. Good morning and welcome back, everyone, to another episode of the Long Game Podcast. Today, we are joined by Tyler Harris. He's a CPA out of Hawaii. He works for, hopefully I don't butcher this, but Gersey and Schneider LLP. So they're basically CPA firm working with kind of this ultra high net worth space. And I mean, if you engage with me on social media, you've probably seen me comment on a lot of Tyler's posts. He's honestly a really great creator in the tax space on LinkedIn. So Tyler, thanks for joining us today, man.
Yeah, Thomas, thanks. I appreciate it. Happy to be here.
Yeah, man, we're excited to dive into this. So like Jacob and I both work with pretty high net worth, high income business owners. And so obviously, as we look into the tax planning side of things, you always go entity selection first, right? And so I think a lot of people, you start out as an LLC, unless you're like, oh, I'm starting this AI backed company and I know I need to be a C Corp. Like in general, almost everybody I come across, unless they've already had a successful exit and they're kind of in that realm, they're not starting out with a C Corp. But as they start to progress, they see that, hey, this business is growing. This might be pretty successful. People really start to look into this C Corp side of things. So I'm excited to really dive into C Corps, QSBS, stacking, packing, all of that kind of stuff. But let's maybe just right away start with like, what's different about a C Corp? Like how does it work?
Okay. Yeah, I mean, obviously the main issue that people have with, maybe not obviously, but the main issue people have with C Corps is it's a separate taxable entity. So what, kind of the hot word that people throw around is double taxation. And the only time there's double taxation really is if you are pulling dividends out of the company. So the C Corp tax rate is 21%. Any profit that the C Corp has is taxed at that rate. Also, with states as well, they also have their own separate state tax, income tax, excuse me. But the idea is that if you're trying to pull profit out of a C Corp, a lot of times people think that the number one way to do that is dividends, which means that when you pull that out, just like you get a dividend from a stock on a publicly traded company and you have to pay taxes on that, you also have to pay taxes at the usually long-term capital gains rate when you pull taxes out of a C Corp. Dividends out of a C Corp. So I guess what that would really look like for someone who's high net worth is you'd have the 21% tax rate, and I'm talking federal only here. And then we also stack on top of that up to 20% for the long-term capital gains rate on the dividends, plus an additional 3.8% if your investment income's over $200,000.
Yep, exactly. So I think that's when people first initially hear this, they kind of get scared, right? They're like, oh man, well, I'm going to be taxed double. But in the grand scheme of things, like it does, even if you're distributing money, end up somewhat similar, right? Like the S Corp, you have the qualified business income deduction, a few other things that try to bring that rate down, but you have the lower corporate rate and then it comes out at capital gain. So they end up becoming somewhat closer. So if you're a business that is not super high cash flow, like a lot of high cash flow businesses, they're distributing that cash. Yeah, you might end up paying more taxes as a C Corp. But if you're a business that is really reinvesting profits back into the business, there's a lot of times you're actually going to pay quite a bit less in tax by being a C Corp.
Yeah, absolutely. I actually did an illustration on this once. Basically, the idea was you pull out half of the profit. And if you're able to look over 5 years, you pull out half the profit every year. You actually end up paying less in tax in a lot of situations, especially if you are looking to sell. If you're not looking to sell, then maybe it's not the best way to go. But with the benefits of QSBS, if you're looking to sell and like you said, you're not looking to hold this business forever. It's not a high cash flow business, but rather more of a value play. Then absolutely you'll pay substantially less tax that way. I agree.
So let's talk about why people really want to be C Corps, or like what is the considerations that help mean this is probably the right entity structure?
No, that's a great question. So, I mean, obviously, you kind of got to begin with the end in mind. So it's really coming down to what what do I want to do with this? Am I going to keep it for cash flow purposes, like we mentioned already, or am I going to sell? If you're going to sell, it's a really good um, a good way to start. If you're not 100% sure what that's going to be, maybe you don't actually move into a C Corp right away. And we could get into a little bit more of that later, but that's actually part of the packing strategy with QSBS. But anyway, the main things you're going to be thinking about is, am I getting ready to sell this? And if I'm in the right type of industry. So um, specifically with QSBS, you have to be, or generally you have to be in a product business. So if you're selling physical goods and that aren't services, that most of the time you're going to qualify. There are some specific niches that don't qualify, such as real estate or any kind of like
Restaurant.
hotel hotel or restaurant business, or the final one is healthcare. If it's a healthcare product or fintech, centered product around healthcare, then that works.
I think
But anything
brokerages.
that's technology based is usually considered as a product.
Yeah, and that's typically the companies that we end up seeing do it the most. I think the other side about this too is a lot of times investors do prefer to be investing into C Corps too. I mean, you know, in all likelihood, there's way less that are going to be buying into S Corps just because of also like different shares of stock. But a lot of the business owners we're working with, when they're going through times where private equity are potentially going to buy in, they're all like, hey, when we buy in, we are going to restructure to a C Corp. And I think it just makes it a little simpler than having it the pass through to them and then take a distribution to pay them to cover the taxes. It seems a little easier just to pay internally too.
Absolutely. The two ways I see it are, I never see S corps when it comes to private equity, but either a partnership situation or a C corp. And I think a lot of reasons. I mean, it could be the QSBS. I think is a part of it, but you're right. It does simplify things for those investors if it's just a C corp. I mean, on a tax side, I don't even report anything most of the time. When I have clients that invest in a C corp, there's just nothing to report. It's great. Makes life easier.
Yeah.
How often do you see business owners coming to you guys, Tyler, and they're not well educated on the different structuring that goes into place? Maybe they read one thing online and they thought I should be an S corp, and then you're able to explain to them, hey, if I'm thinking about potentially selling this business, maybe we should look at a C corp, and maybe they come back and say, well, I've heard double taxation. So how much of your role now is helping to educate them on what the best options might be?
I mean, it is a pretty big part of our role. A lot of times, if they're already an S corp, and I've had people come to me who are looking to sell in the next 3 to 5 years, and those clients we generally are saying, what, it's worth it just to stay as the S corp
It's too
because of your
late.
timeline. Yeah, it's a little too late. Um, if I was to advise, so I would say that's not as much of the role. What I really like to do is get people who are looking closer to the startup part, because I do have a lot of people that have already set up their business. It's almost always too late. But if we had clients come to me, I'd probably just start them out in an LLC. Tax is either a single member LLC or a partnership. Um, and then we can always readjust based on what their needs are from there. But the LLC is like really the most flexible, uh, entity that you could get set up in, and then you can actually be taxed as an LLC in all the different ways. So as a single member or corporation, partnership, etc. Um, but but yeah, so I mean, yeah, unfortunately, it's usually too late. But yes, definitely starting it out as an LLC, quite often as a single member LLC or partnership is the way to go. People balk at, like, they get scared of the self-employment tax implications, but honestly, when you're looking and getting yourself, unless it's a cash flow business, you're probably going to either want to stay as a partnership or a C corp.
Yeah.
The,
That's
the
kind of how I look
self-employment
at it.
tax is pretty small overall.
At the end of the day, you're probably, if you're going to be a high performer, going to make above the Social Security wage base. So you're paying an additional 2.9% tax. Like, this isn't something that is going to break the bank. But I do agree. That's how I look at it. A lot of times, like, if you're a really high cash flow business, that's the time, especially if you're non SSTB, where S Corps make a lot of sense. Because a lot of times those are the same businesses. These are all service businesses. They're not going to get QSBS anyways. That starts to make sense. The other side here, I mean, you've been alluding to this now. Like, I think that start working with people, you want to work with a team 5 years or earlier. And you talked about, hey, C Corps, when people are thinking about selling. So what you're really getting at here is really trying to hit on QSBS, and that's one of the biggest value adds. So let's kind of dive into what QSBS really is, how it helps, all that stuff.
Sure, absolutely. So, yeah, you're right. I have been hinting pretty hard at QSBS, and not everybody qualifies. So let's definitely talk about the qualifications. But QSBS is basically, to give you a history. It's been in the tax code for a little while. It's since like the 90s, but it really became more appealing to people back in like 2008, 2009, and that's back in that time period. Obviously, we had the Great Recession. We had um, a lot of basically the government was trying to figure out ways to incentivize people to invest again in the economy, and so they increased the exclusion on capital gains up to 100% exclusion. Um, and basically, you could sell, as long as you've met the requirements, some stock in your company for up to a $10 million exclusion. Now, there are lots of strategies on how to boost that above $10 million. But that's the general basics of it. Um, and I don't mean to get off topic, so I apologize. But mainly the question is who qualifies, and that's basically any kind of product type business. It usually excludes service type businesses. If there's an opportunity to have where you have kind of both, I found that quite a bit. It might make sense to set up the product business as a C corporation, and then maybe have a relationship where the services are performed actually by a flow through entity, such as a partnership. But basically, the idea is you need to make sure that 90 or 80% or more of your activities are centered around the product. And so, again, fintech usually works really well with that, or any kind of tech, like software as a service type company. Anything where it's a product, that's exactly what you're looking for if you're doing QSBS.
Will you see people in that situation do holdcos then, and they'll have holdco here, then they'll have the service here, and then they'll have the C Corp over here?
That's a good question. That would make a lot of sense. I honestly, I'm not sure if I can comment on the whole co-structure as much. Probably the best person to talk to is like an attorney with
Totally
that.
fair.
But but yes, generally I would say that there's some sort of hold co. Usually it's some sort of again, it's a flow through usually in that situation from what I've seen.
Yeah. So I guess going back, so QSBS, you get basically up to $10 million or 10 times your basis, whichever is greater. So, I mean, that's really, really big, right? You start a business, it's worth nothing. You go and sell it for $20 million. Let's say we own Stack, we don't own anything else. You get $10 million tax free. We're going to take out the basis raised or any of those type of things. So $10 million, you're saving 20% plus 3.8% net investment tax plus state. So like a lot of these people I work with are in California, right? So that's a 36 to 37% difference. $3.7 million on 10 million, except for California, right? We'll go back and say you still pay state taxes because California is the worst about it. But in
Yep.
general, it's a big difference.
Yeah, it's huge. I mean, if you're looking to sell your company, yeah, 37% is that's a lot of money you could walk away with, and it's a huge amount of value you can add. And you mentioned California, so I just wanted to clarify that California does not conform. Not all the
Yeah,
states
that's
do
what I
conform
said.
to QSBS, and so yeah, good catch on that. There are ways around that. So either through trusts or just moving. I've also had clients like move across country to states that conform before the sale so that they can get away with it.
Which works. You just have to have the residency for a bit. And it's funny because I use California. I did the same thing with like HSAs. And I was like, gosh, of course. Like right after I used the best example with the highest tax savings, you're like, of course, that's the one state that doesn't honor it. But
Yep.
okay, so that's the really big part. Before we go into stacking it, when you're evaluating this with people, um, I'm curious how you do it because like I'm talking to somebody right now. We have a business owner who they actually have a really high cash flowing small little tech company, which is the weirdest thing ever, right? Like he's making $1.5 million a year. That revenue is like a couple, like 3 million maybe. He makes a ton. To move to a C corp would be about 25K of extra taxes per year, right? So
Hmm.
you're like, that's enough to make you think about it because if he's going to do it for 10 more years, that's quite a bit extra in taxes. And then what if the business doesn't end up becoming sellable, right? Like what if new tech comes on or nobody wants to buy it 10 years from now? So like how do you evaluate that type of scenario?
Yeah, I mean, it's a good question. I think it really just comes down to what your goal is. If you could see yourself selling within 5 years, or sorry, outside of 5 years, after 5 years, um, and that's what your goal is, like you want to, let's say, retire or just kind of get out of the game, then I 100%, like 99% of the time, I'm going to say let's try to save you some taxes on the sale. Um,
And that's how I feel too. Because even if he
but
sells for 4 million, it's still that's a really big impact. Still, I mean, even just that's 800,000 plus of tax savings to pay over, let's say, 5 years, 125K. Like that's a pretty good return on investment.
Yeah, I agree. I think you really just kind of have to kind of figure out what the net present value is of each decision, and figure out, if what what you're most comfortable with. But really, it's just like looking at the cash flow and saying, okay, well, I might pay, like you said, $25,000 more in tax every year, but if I have that optionality to sell and have that massive um, payoff in later, in the form of tax savings, and then that's what you would want to look at. The other thing is there is a little bit of opportunity as well to kind of maybe boost your wages in a year, um, or something like that, because the dividends aren't the only way to strip profits out of a corporation. So just another side point. Potentially, you could set up another entity as well, as long as it's doing a legitimate service. You could push a lot of income out through a different entity as well,
Good point.
like paying 1099 to like, let's say, an S corp or something on the side, as an example.
Yeah, I actually have a few clients doing that, where they have a C Corp and they pay each of the owners from their own specific S Corp, and that's what their tax attorneys recommended. So definitely a strategy that can work. But let's stay on this. Let's talk about multiplying QSBS, right? So 10 million is really great, but we're not happy with that. We want to figure out how you stack more. So how do we get to the point from going to 10 million to you might get 40, 50, 60, 70 million?
Yeah, it's a great question. So we're talking about stacking, and really what it is you get the $10 million exclusion per taxpayer. And I do want to clarify, because this is a place where people mess up a lot, is they think that well, I have a husband and wife, so therefore it's a $20 million exclusion. It's actually not. If you file jointly, you're considered one taxpayer. So the way you can bump that up is actually using non-grantor trusts. And a non-grantor trust is basically a trust that you don't have control over anymore. It's an irrevocable trust, which means that once it's set up, you typically have access to the funds. Usually they're a completed gift trust, and so you would have to file a gift tax return to report the gift. But we also quite often will set them up um, either as some sort of I don't know how much of your audiences would understand the industry lingo or jargon, but we could set it up as either called a slat or a slant, which means that you would have some optionality to make your spouse a beneficiary, and so there is some options to, let's say you're a little scared that you're going to run out of money or something. There is an option where you could pull money back to your household through your
Which,
spouse.
let's say pretty much everybody does have that fear. Like I'm
Yeah.
working with a bunch of people in this space. It doesn't matter how much money they have. Everybody is fearful. And I get it. Like putting myself in your shoes, you're like, well, I made all this money. Do I really want to just get rid of everything and put it in a trust that I cannot touch? But you're right. Slats is the one area where it's not like you're going to use it like a piggy bank, but it does give you and your spouse access to it. So I think anytime
Yeah.
I ever come across this, that is the first place most people
Yep.
start, is because then you still can have a little bit of use and control relative to any of the other trusts.
Yeah, so it's absolutely it's kind of a no-brainer. So, and quite often they'll start sometimes they'll start as a grantor trust. So I have a client specifically who this in 2023 he set up two trusts that were grantor trusts, and when they received the money, the state attorney helped them set it up so that when they received, when they were about to sell, it ended up getting broken up into an additional three trusts. So there 3 trusts each, excuse me. So there's 8 total, and they were able to sell the QSBS. And at that point they switched from grantor trust, which means that all the income is reported on their individual tax return, to non-grantor trusts, which means they're separate taxpayers at that point. And really, so basically, what I'm trying to say with all of this is you need to have a really good estate attorney to help you. I think a CPA is who understands this can definitely be an instrumental tool in this to bring forward the idea, help you execute it, get the compliance correct. But really, you're going to need an estate attorney to draft all these documents.
Absolutely. It's really a 3-person team here, right? Like in every
Yeah.
situation we see, it's like, okay, financial advisor might be the first person to talk to the person and say, hey, you need to do this. We need to bring on 2 great people, a great CPA who does understand this, because we've interviewed CPAs that our clients are working with, and they barely know anything about QSBS, let alone the ability to stack it, right? If that's a new idea, we probably need to bring on a different team member. And same with estate planning attorneys, right? You need state specific and somebody who also specializes in this, because everybody in all 3 of these roles on a year, just not even just set up, but on a yearly basis, has to be reporting and doing all these things correctly, right? You need to report the tax stuff well. The estate planning attorney has to draft it right. We have to have trustees and do all of that, but also the trusts have to be maintained and cash flow has to exist, because if there's just that in there, they have to be paying the taxes inside of those trusts.
Yes, absolutely, absolutely. So, in the situation where it's I guess there's just different ways to do it. So if you have a lot of gift tax, if you still have a lot of money that's inside of your estate and you have not used up your gift exclusion or your state tax exclusion, then gifting is a great way to go. I'm thinking about this specific client who actually set up what's called an IDGIT, but basically what it is, it's like it's a trust that's still reported on his return, and he actually had the trust buy shares from him, so that they would have kind of it was all done on a loan. Anyway, I don't know how deep to get with that, but the point is something, if you could be proactive, you could set up multiple entities, and when you do that, you're going to get the exclusion. Excuse me. So anyway, that's I guess that's the basics right there.
I think you're doing a great job here, because I think at the end of the day, like the lens of this is not like, hey, business owner listening to this podcast, go set up your trust and, let's get you 40 million tax free. It's, wow, I never knew this was an idea. I need to make sure that I'm working with a team of people who can help me implement this, and I can bring this idea together, because all the time I'll have a new client come into me. They're successful. They have a high net worth, but they're paying an attorney or a CPA $800 a year to file a return. And they're like, why did we never talk about stacking QSBS or doing all this? And you're like, you hand your person the documents, they've never met you in person, they talk to you for 30 minutes a year. Like, this is not a CPA's problem or their fault. It's that you have not tried to build in the right services to help you do this, right? Like, you guys are a type of CPA team that you're only going to work with people probably on a proactive planning approach with this type of audience. And that's really what you're looking for. And I think this is the time where people are like, oh my gosh, I'm going to pay an estate planning attorney $30,000. I'm going to pay this tax team $25,000 this year. I have my financial planner. Like, gosh, it's like, yeah, but when you're talking about $40 million of capital gains tax free, that's a pretty good investment. And so I think a lot of what I try to teach people is like, these are investments. You're not going to get these results without investing in the right team. Like, there's just not a way that you can do it.
Yeah, and I think a lot of this is, I honestly, I think about stacking as being a little bit less of a proactive approach compared to packing, which is the other strategy we have around QSBS. But basically, if you understand that you're going to that you have profits, that this company is potentially going to sell, you can implement this when you have a decent understanding that, hey, I'm going to sell. There's good profits here. I can afford to spend, $60,000 a year to get all this set up. I guess maybe 60,000 the first year, and then probably a little less following that. But yeah, absolutely. Like, you don't have to be thinking about these things when you have only $20,000 in the bank. It's more of, hey, I have something here. I know it's going to hit, or I'm pretty sure it's going to hit, and now I'm going to put that investment in. So I think if people can understand that, like, it doesn't have to be right at the very beginning. Obviously, you have to get the right entity type. You have to set all that stuff up, but that's pretty low cost compared to the actual planning to get the trust document set up and all the different entities established.
I think the other thing too that people don't realize is they read something online about QSBS, and Thomas, to your point, they think that like it's pretty simple. Like I read this thread on it and I can figure out how to do it. And Tyler, to your point, it's like once you do one thing, then you have the opportunity to maybe do another thing. But with each one of those things you do, you add another level of complexity that realistically is not going to go away in the future. So I think it always goes back to like what we were talking about at the beginning of this podcast was you have to start with the end in mind. Like how complex do you want your financial life to be? You know, Thomas, we talked to Ankur about this, and he didn't do all the stacking he could have done because he said, you know, at a certain point, I don't know if I really want, you know, other people in my family to have access to $10 million tax free because I'm not going to really have control of these trusts. And yeah, I could keep going on down the line, but instead just saying like, what is a reasonable thing that I want to do that's also rational for me, that sets a good expectation of what I want in the future? Because once you start down this path, you can't just shut it off if you set up all these irrevocable trusts. Like there needs to be constant monitoring going on.
Yeah. I think I just can't get over how important it is that, you know, we all tell people like, you should be thinking about these things earlier than most do. Like I have 3 new clients this year that I've signed that will sell their business for 30 to $100 million in the next 2 to 3 years. And they're an S Corp. All of them are an S Corp. And sure, that was great. And they're like, I'm not waiting 5 more years. Like this has been a grind.
Yep.
I'm ready to get this sold. And within 2 to 3 years, like C Corp conversion is not something I want to do. But if they would have worked with us 2 to 3 years earlier, I mean, they would have the difference of all of the estate taxes they're going to end up paying pretty much literally in tax savings just because they were proactive enough to think about this before the exit is happening.
And to your point, Thomas, I mean, that's okay. I mean, if you're 3 years out and you're going to have a $30 million sale,
You won.
like you're not in a, what's that?
I said you won. You did a great job. Like
Yeah.
I'm not taking away from that.
And to some extent also your people want to buy flow throughs as well. It's not like being a S Corp is going to really kill you. There's other strategies where I just did one with a client this last month during busy season, but we did a type F reorg, and they purchased the company, but they purchased it as a single member LLC after the reorg was done. And so at that point, the purchaser can do whatever they want with it. But I guess what I'm trying to say is when you purchase a flow through, there are some tax benefits to the buyer that will make them pay a little bit of a premium for that. And a C Corp won't have that for them. So your proceeds might end up being 10% higher because of the fact that it's not a C Corp. So it's not going to kill you, but the other side of it, there is definitely a ton of tax savings if you just start, you know, with the end in mind a little bit here and could set this up. So,
Yeah.
you know, there's pros and cons. There's a bit of give and take with all of it, but if you're with the right advisor, they could probably help you have a really good situation anyway, a really good outcome.
Yeah. So let's go into packing. What does packing even mean?
Yeah, so packing is a strategy that allows you to get more basis in the QSB stock that you start. So let me give you an example, but or just a breakdown. So the rules break it down to you get $10 million of exclusion or up to $10 million, or sorry, 10 times your basis. And so there's different ways to increase your basis, and I guess they're all very similar, but that's the strategy around stacking or packing, excuse me. You're just trying to increase your basis. So you could either, you know, throw $50 million into an empty C Corp. And if you're rich, you could do that. But most people don't have the money to buy $50 million of stock in a company that doesn't do anything yet. But generally what you would be doing is you're looking to start as a flow through entity or a single member LLC. And then what we could do is something called the 351 transfer. But you build the valuation up in that flow through entity up into something above $1 million. And you'll get the 10 times basis now on, like, let's say 3 million or 5 million. And when you have somebody come in and raise money at that higher valuation, your tax basis might be zero, but your QSBS basis could be substantially higher, and it's based on the fair market value at the time that you convert to a C Corp.
So if you're the idea, right, that you could take QSBS eligible stock and roll it to another company, right? Like that's basically what you're saying you're doing here.
Well, that's actually called a 1045 rollover, what you mentioned.
Yeah.
The idea would be actually to try to raise the valuation of your flow through of your LLC before you actually convert to a C Corp. So
Oh, okay. I see. It's not C Corp to C Corp. It's pre C Corp.
it's pre C Corp.
Got
Exactly.
it.
So this is really, really, really beginning with the end in mind. And it starts the clock when you make that transfer, it starts the clock on the transfer at the 5 year clock when you convert to C Corp. But basically what you're doing is you're taking an intangible. You're taking this company that you've built, and you're contributing that at its fair market value into the C Corp to start the clock on the QSBS exclusion. So functionally speaking, the way that would work is, let's say I built it up from zero to $5 million on my own, and now I'm raising money from investors. When my once we give a valuation on the company, that company that I trade that I transfer in, the intangible asset, the company there, whatever the value is tied to, once you transfer that in, you get your QSB basis is based on the value of the company when you transferred it in. So you didn't actually put cash in, you put your company in to the C Corp. And then when it comes to selling, so let's say you put 5 million in, that means you get a $50 million exclusion. If you sold it for $100 million, you get $50 million excluded from capital gains tax. I will say that the one thing, it's a 351 transfer is called a tax-free transfer. When you transfer that money in, the QSBS basis gets bumped up, but your basis in the original stock is still like zero or whatever you put into the company. And so you do have to pay tax on that first $5
Zero
million
to five.
when you sell. But so theoretically, to use up your
Pretty
full
good,
$50
pretty good
million,
outcome though, to pay tax on the 5 million and not the other 45.
I mean, it's great. Yeah, exactly.
Yeah.
So that's the idea.
I mean, that's super. I mean, it's almost like the people I'm talking to, if they were going to have that clock, that would be a great situation because their companies are already worth quite a bit and they lack assets too. They're not like over the 50 million asset classification. I think, maybe talk about that because I feel like a lot of times people hear the requirements and they say, well, it has to have, less than 50 million in assets. But a lot of times people think it's like value, people think it's revenue, but it's really assets, right?
Yep. Yeah, it's defined as gross assets in the company. So that'd be like your cash, your um,
Trucks or,
equipment, trucks, yeah, all that stuff. It's just like the physical assets that are there. So it's not your valuation. The valuation can be much higher, but as long as yeah, it's just on the assets. I don't know how much more to say there is to say about that.
Well, it's just a lot of companies qualify when I think people would assume that they wouldn't because they have high valuations. But a lot of these tech companies or other ones who are qualifying, they're not even asset heavy businesses in any way.
Yeah, I've seen people, maybe not the founders of the companies, but people invest in some of these companies when they're Series A or Series One or like their first round, and like they still qualify. So I've gone back and like had them ask, hey, when I bought this stock, did you guys have did you qualify? And I've found savings for clients that way before too, because I see that, oh well, it looks like when they bought this it was pre-IPO. So like I'll go back and have them ask, and we find out it's QSBS, and it's just they save tons of money. But yeah, exactly to your point. That's chances are you do qualify even if you're
Yeah.
a fairly big company.
And I guess for people to know, that's a really good call out. Like all the time I talk to people and they're like, I have no idea if this is QSBS eligible at all. Is this a recommendation from you? Just reach out to HR and say like, hey, at this time, because a lot of times there isn't just easy access to give you that information.
Yeah, I would say probably try to talk to somebody who's in the accounting team. If you could talk to the controller or the CFO, they would have a much better idea. They could go back and look at the historical financials and see where they're at, and let you know if they qualify. I mean, yeah, definitely somebody who has access to the tax returns or somebody who has access to the books is who you need to talk to.
Okay.
Tyler, do you see on the packing strategy, do you see any companies moving to a C Corp trying to do the packing strategy and they're not going to raise outside capital, but maybe they're going to just keep all